Assalamualaikum warahmatullahi taala wabarakatuh. Hi, my name is Muhammad Hafiz bin Muhammad Noor. Principle of Entrepreneurship, ENT530, Organization Plan, Chapter 5 and 4. We are from Group 8. I would like to introduce a group member. My group member is Muhammad Syahir Aiman bin Abdul Wasid, Filza Nadira Arzman, Farah Nadira Yunus, and I Hafiz. Developing the management team. Investor demand that the management team not operate the business as a part-time venture. It is assumed that the management team is prepared to operate the business full-time and at a modest salary. An attempt to draw a large salary out of the new venture may be perceived as a lack of commitment to the business. Legal form of business. 3 basic legal form of business. Proprietorship, single owner, unlimited liabilities, control all decision and receive all profit. Corporation, most common form of the corporation, regulated by statute, treated as a separate legal entity for liability and tax purpose. Partnership, 2 or more individuals having unlimited liability who have deployed resources to own a business. New form of business formation. S corporation, limited liabilities company, limited liability partnership. 3 form of business formation. Factor, ownership, proprietorship, individual, partnership, no limitation on number of partners, corporation, no limitation on number of stockholders. Second, liabilities of owner, individual liable for business liabilities. In general partnership, all individual liable for business liabilities. Limited partner are liable of amount of capital contribution. In limited liability partnership, there is no liability except when negligence exists. Amount of capital contribution is limit of shareholder liabilities. Cost of starting business. None other than filing fees for trade name. Partnership agreement, legal costs and minor filing fee for trade name. Created only by statute. Article of incorporation, filing fees, tax, and fees for state in which corporation registered to do business. Continue 3 forms of a business formation. Factor, transferability of interest. Proprietorship, complete freedom to sell or transfer any part of business. Partnership, general partner can transfer his interest only which concern of all other general partners. Limited partners can sell interest without consent of a general partners. No transfer of interest in an LLP. Corporation, more flexible. Stockholder can sell or buy stock at will. Some stock transfer may be restricted by agreement. In S corporation, stock may be transferred only to an individual. Second, capital requirement. Capital rise only by loan or increased contribution by proprietor. Loan or new contribution by partner require a change in partnership agreement. In LLP partnership, any entity raise money. New capital rise by sale of stock or bond or by borrowing debit in name of corporation. In S corporation, only one class of stock and limited to 100 shareholder.
Hi, my name is Muhammad Syahir Aiman bin Abdul Basid. These are 3 forms of business formation. First factor is management control. For proprietorship, proprietor makes all decisions and can act immediately. For partnership, all general partners have equal control and majority rules. Limited partners have limited control, can vary in an LLP. For corporation, majority stockholders have most control from legal point of view. Due to the control in hands of management who may or may not be major stockholder. The second factor is distribution of profit and losses. For proprietorship, proprietor responsible and receive of profit and losses. For partnership, depends on partnership agreement and investment by partner. For corporation, shareholder can share in profit by receipt of dividend. The last factor is the attractiveness for raising capital. For proprietorship, depends on the capability of proprietor and success of business. For partnership, depends on the capability of partners and success of business. And for corporation, with limited liability for owner, more attractive as an investment opportunity. Tax attributes of forms of business. Tax issues for proprietorship. IRS treats business as the individual owner, not regarded as a separate tax entity. All income appears on owner return as a personal income. For tax advantage, no double tax when profit are distributed to owner, no capital stock tax or penalty for return earning. Tax issue for partnership. Tax advantage and disadvantage similar for sole proprietorship. Tax issue for partnership. As the advantage of limited liability, treated the same as the LLC for tax purpose. For tax issue for corporation, can take many deduction and expense not available to proprietorship of partnership. Distribution of dividend is taxed twice. Double taxation can be avoided if income is distributed to entrepreneur in the form of salary. Tax attributes of various legal forms of business. Taxable year. For proprietorship, usually a calendar year. For partnership, usually calendar year, but other dates may be used. For corporation, any year end can be used at beginning. Any changes require change in corporation. Distribution of profit to owner. For proprietorship, all income appears on owner return. For partnership agreement may have special allocation of income. Partners pay tax on their pro-rate shares of income on individual return even if income not immediately distributed. For corporation, no income is allocated to stockholder. For organization cost, proprietorship not amortizable. For partnership, amortizable over 60 months, and corporation also amortizable over 60 months. For dividend received, the proprietorship 100 dividend exclusion for single return and 200 on joint return. Partnership, dividend exclusion of partnership passed to partner. Corporation, 80% or more of dividend received may be deducted.
Hi, my name is Filza Nadira binti Arzman, and I would like to explain for my part, which is the limited liability company versus S corporation. Venture capitalists prefer limited liability companies as a form of business entity, and a new regulation allows limited liability companies to be taxed as a partnership. S corporation was the most popular choice of organization structure by new ventures and small businesses, and growth rate of S corporations has leveled off mainly because of the wide acceptance of limited liability companies. What is S corporation? S corporation is a special type of corporation where profits are distributed to stockholders and taxed as personal income. The Small Business Protection Act of 1996 reduced some restriction. In 2004, Congress responded to criticism of the restriction on S corporation as compared to limited liability companies. Intent was to make the S corporation as advantageous as the limited liability company. Status of the S corporation must be monitored and maintained. And there some advantage and disadvantage of S corporation. For advantage, it is capital gain or losses as are treated as personal income or losses. Limited liability protection, not subject to a minimum tax. Transfer of stock to low-income bracket family members. Stock may be voting or non-voting. Cash method of accounting. And lastly, corporate long-term capital gains and losses are deductible directly by the shareholders. And for this advantage, some restriction for qualification. Potential tax disadvantage. Most fringe benefit not deductible for shareholders. Must have a calendar year for tax purpose. Only one class of stock is permitted. Net loss is limited to shareholder stock plus loan to business. And lastly, no more than 100 shareholders. What is limited liability company? Limited liability company is a partnership or corporation hybrid, which is transfer of interest require unanimous consent. Limited liability companies is no share issued, which is each member owns an interest as designated by the article of organization. It also does not extend beyond member capital contribution. And some advantage for limited liability companies. First is partner can add their proportionate share of the limited liability company's liability to their partnership interest. Second, most states do not tax limited liability companies. Third, one or more without limit individual, corporation, partnership, trust or other entities form and limited liability companies. And lastly, members share income, profit, expenses, deduction, loss and credit, and equity of the limited liability companies among themselves. And as per slide, this is a chart of designing the organization. This is the entrepreneur's formal and explicit indication to the members of the organization as to what is expected of them. Expectation can be grouped into first training, selection criteria, rewards, planning, measurement and evaluation schemes, and lastly, organization structure. For the stage in organization design, there are two stages. Firstly is stage 1, which is president and also divided into 3, which is production, marketing or sales, and administration. For stage 2, there is president and also divided into 3, which is production, marketing, and administrative manager. But production manager is divided into 2, which has quality control and assembly. Marketing manager also divided into 2, which is sales and promotion advertising. And for administrative manager is divided into 3, which is finance, accounting, purchasing, and shipping or receiving. And that's all from me. Thank you.
Hello everyone, my name is Farah Nadira binti Yunus. I will present regarding on how to build the management team and a successful organization culture. There is two main factors. The first one is a management team must be able to accomplish 3 functions. The first function is identify fundamental changes in the business as they occur and make adjustment to the plan based on the changes in the environment and market that will maintain profitability and execute the business plan. Second one is establishing an effective team by using these few important factors. The first one is desired culture must match business strategy outlined in the business plan. Core values and appropriate tools must be provided for employees to effectively complete their jobs. Employees must be motivated and rewarded for good work. Entrepreneurs should be flexible to try different things and spend extra time in the hiring process. For the role of a board directors, there is few functions of the board of directors. The first one is reviewing operating and capital budgets, developing longer-term strategic plans for growth and expansions, spotting day-to-day activities, resolving conflicts among owners or shareholders, ensuring the proper use of assets, developing a network of information sources for the entrepreneurs. For being a board of directors, they have to meet the requirements of the Sarbanes-Oxley Act and the following criteria. The first one is ability to work with a diverse group and commit to the venture's mission, ability to understand the market environment, ability to contribute important skills to the new venture's achievement of planning goals, and ability to show good judgment in the business decision making. There is few criteria for the board of advisors, such as they serve only in an advisory capacity, no legal status, not subject to regulations stipulated in the Sarbanes-Oxley Act, likely to meet less frequently, useful in a family business. Selection process is similar to the process for selecting a board of directors. Advisors may be compensated on a per meeting basis or with stock or stock options. Site advisors are usually used on an as-needed basis. They can become a part of the organization and need to be managed. The relationship between entrepreneur and outside advisors can be enhanced by involving them thoroughly and at an early stage. And even after hiring advisors, the entrepreneur should question their advice. That's all, and thank you everyone.